First, we have Chloe from Schroders, we have Rhee from JP Morgan Asset Management, and Alec from Abrdn. So, thank you guys for joining us today. As we begin, I'm just gonna obviously we have to show disclaimers as a SFC regulated entity. But just an introduction of Endowus for those that are less familiar with us. And we don't put all the funds on our platform. We're not a supermarket. We actually have an institutional level due diligence process. Chloe and I knew each other from way back, and the roles were reversed, and Chloe used to be on the other side reviewing my Morgan Stanley investment management funds. So it's really good to see you again. But really trying to provide institutional level advice and curation and services. And it really is about restoring the fiduciary duty of wealth advisors, always putting our clients first and doing what's in their best interest to achieve better outcomes, because ultimately that's what we're here for. So institutional access and low fair fees, and I would add that it's low and transparent and it's all in. And so it's a flat fee based on your assets, not any commissions, not based on transactions. So all of the disincentives, misalignments are removed as well. But what we're really focused on is providing you and journeying with you as clients across your whole wealth journey, right? As an individual, we don't receive the kind of advice and financial planning that we deserve. And I think that every single individual deserves to do that, to have that. And Endowus was built to really provide institutional advisory solutions and make it available for everybody, true democratization. And the process is an institutional process because, as I explained, Morgan Stanley Investment Management, where I was for over a decade, really is a completely institutional outfit. And working with sovereign wealth funds and big pension programs in the US and globally, with endowments like Yale Endowment, etc. I think providing that kind of institutional advisory focus on asset allocation and diversification and all the right way of investing is really important. And so, as an individual, it's important to be holistic in your approach. So everybody has a brokerage account, they have IBKR, they have they use a private bank or a retail commercial bank, and they have different pockets, and we don't even know where we even keep all our investments. And we don't have a complete picture of our financial well-being. And so bringing that together and being holistic and focusing on a systematic, evidence-based approach and really instituting institutional frameworks like liabilities-driven investing, or commonly known as goal-based investing. And Endowus is a technology platform that has been built to really provide you with seamless execution of this asset allocation strategies across multiple different time horizons, different asset classes, and multiple goals on the same platform. So in Singapore, we were the first to digitize the national pension system called the Central Provident Fund. And so we're the only digital wealth platform it's the only wealth platform where you can manage all of your source of funds, including your public pension and your private wealth. And in Hong Kong, our plan is to broaden out from our current wealth offering to also take on the ORSO and MPF solutions as well. So we work with wonderful partners like the three companies represented here. Some of our longest relationships here are represented Abrdn, JP Morgan, and Schroders. But we are agnostic. And being independent means that we actually work with every single manufacturer of product so that we can offer the best-in-class solutions that is most suitable for you. And we started with public market equities, passive, systematic, but now we've expanded into the private markets and alternatives solutions, working with some of the major global GPs to provide evergreen open-ended products, which are fully diversified across vintages, sectors, and geography as well. So those kind of solutions are unique to the Endowus platform as well, and always at the lowest cost, and also, most importantly, at much lower minimums. So you can start with 100,000 in Millennium and 0.72 hedge funds, or KKR and Apollo and Carlyle products. And just re-emphasizing that fees, just like investments, compound over time. So even a 1% difference in fees over 30 years compounds to a 250% difference in returns. So it's a difference between 7.5 million and 10 million. And that's a meaningful difference. And so if you can reduce fees without doing anything, without taking any additional risk, you can meaningfully improve your returns. And that's why it's so critically important for Endowus to always work with our partners to offer the lowest cost solution possible. And we started as an individual solution, but we've really expanded to professional investors, high net worth individuals. We work with now multifamily offices and single family offices. One key sector that always falls through the cracks is the non-profit and charity sector. They're not very well taken care of by the private banks or the commercial banks. They often have to go directly to the fund managers who are not normally willing or able to receive them, and they don't often benefit from diversification and good advice, because that's the role of a financial advisor. And so we work with many charities, non-profits, and we feel that this is really important for us as a company with a very meaningful mission and purpose to give back to society, and serving this community is a really important part of our journey. And obviously we have increasingly institutional, quasi-institutional clients that are coming onto the platform. So that's where the name comes from, endowment investing for all of us, and really bringing institutional quality services to everybody. So with that, there is a QR code for those of you who haven't signed up. I think a lot of you are already clients of Endowus. But we're going to kick off with maybe a quick intro, just to warm you up and your throats warmed up. From the other side, maybe Alec, can you give a quick intro of, first of all, yourself, and I think for those who are less familiar with Abrdn, maybe a quick intro of the company. And is it possible to turn off the music? It's a little bit annoying. So, if you can, yeah, thank you. Alec, over to you.
Yeah, okay, hi everybody, I'm glad to be here. My name is Alec, I'm one of the fund managers for Abrdn. Abrdn is a UK-based, one of the top fund manager globally. And I am part of the China team. So we have been investing in China here in Hong Kong since the 1990s. We have about 3 billion assets invested in China. Majority of them is in China A. So we've started China A fund back in 2015 with a very small amount of money, about 10-20 million. Now the size is about 2.4 billion. Finally, we're long-term positive on China. I'm going to go into that in depth later on. Yeah,
sounds good.
Happy to exchange ideas with you.
Thank you, Alec. Terry.
So my name is Sai. I'm with JP.
At the bottom. Yeah.
Hi, my name is Sai. I'm with JP Morgan Asset Management. I've been with the firm for 11 years, but I've been with the financial industry since 2000. So JP Morgan essentially is a asset manager that cuts across equity, fixed income, alternatives, and liquidity management. We've been in Hong Kong since the 1970s, but obviously we've worked with all sorts of clients, from retail to institutional to distributors, as well as sovereigns. So we do have a lot of expertise in asset management in terms of research, in terms of distribution, and more importantly, how to allocate assets over the different cycles. So look forward to share that with you today.
Wonderful. Chloe.
Hi everyone, I'm Chloe from Schroders. I am from the multi-asset team of Schroders. Schroders, like Abrdn, we are a UK-based company, and we are one of the largest European asset managers. In Hong Kong, we have been in Hong Kong for since 1970s as well, and we have been running multi-asset mandates since the 1970s as well. So we have a long presence in Hong Kong, especially for the multi-asset team. We run money for, let's say, the pension clients like ORSO and MPF, as well as institutional and retail clients. So looking forward to sharing with you our market views and how we are planning to allocate in the future.
So we intentionally chose a very diverse group. So multi-asset, kind of Tyree is a strategist, but does macro and pretty much everything. Alec is our specialist because obviously we're in Hong Kong and China is topic du jour, and everyone's very curious about the outlook for next year, whether it's an opportunity. So, and I'm a primarily an equities person. I invested in public market equities for a long time at Morgan Stanley. And so we have a very broad range of speakers. And so I'm going to kick off top down. So macro, and maybe Tyree can kick us off here. What is the outlook for next year with Fed interest rates possibly peaking? Are we going to see that come down? How does that affect financial markets, and what does that mean for growth? Yeah.
That's good news and bad news. I think if you look at the growth outlook for the global economy, starting with the US and Europe, ultimately high rates slow growth down. I mean, that's exactly what central banks want to do. So we already started to see a lot of slowdown in Europe, in the UK, and I do think they'll go into a recession. But in the US, I think one of the biggest mistakes I've made this year was to underestimate how resilient the US economy is in the face of higher rates. There are some buffers, for example, I'm super envious of my colleagues in the US, where their mortgages, if they bought a place in 2021 or before, for the next 30 years, effectively their lifetime, they're paying 3%. So higher rates from the Fed does not really change the way they pay their mortgages. But obviously, it does impact on new loans. It does impact on corporate lending. So eventually that will eat into the growth momentum. So I think next year we do expect US and Europe to slow down. I think the US can still avoid a recession. In China, I would say flat, steady, nothing catastrophic, but obviously the real estate market is going to be the biggest challenge. I think the last point about macro is that Asia have had a really hard year when it comes to exports. I think that's going to change. We're starting to see some modest improvement in export performance, and that's going to be really important in driving earnings over 2024. So really there's a mixed bag, and I think that allows us as asset managers to really make the most of the market condition that we expect to see. For the Fed, we think they're done with raising rates. But I do think the market is a bit too optimistic to think that they'll start cutting rates in the first half of next year. Ultimately, they made a big mistake in expecting inflation to be not an issue. They have to self-correct, they have to overcorrect, and therefore in next year, I think they have to also be a little bit more focused on making sure that inflation is put to bed. And hence, I'm not expecting rates to come down anytime soon on the policy rates front, but as we saw in the last few weeks, bond yields are starting to come down. And in expectation of the Fed at least hitting the peak in policy rates. So from an overall asset allocation perspective, I'm actually quite constructive in 2024. I think that we could see both stocks and bonds do well next year, which is obviously the opposite of 2022, when stocks and bonds both did terribly when central banks around the world are hiking rates.
Okay, I'm going to follow up with Chloe, and as a multi-asset person, I do have to ask about, although this is an equities session, maybe rope in fixed income for us, and how's it looking, especially with the outlook for interest rates? And Schroders' views.
Sure. I think as a multi-asset investor, I totally agree with Ty. Last year, especially, was super painful for our multi-asset strategy because normally you would expect diversification between two different asset classes. When equities are going down, bonds would help you to hedge against that risk. Obviously, because of rising interest rate environment, that didn't happen, and equities and fixed income, like Ty said, went down together. I think next year we are expecting, from an economic point of view, some divergence between certain markets. I think we are on the same page together. In a way that we don't really think that the US is going into a recession and the economy is doing quite resiliently. However, in Europe, you can see that PMI numbers are coming down, and therefore we do believe that Europe, there is a possibility for a recession there, and therefore there also is a divergence between the central bank's policy. We are expecting Europe, or ECB, to probably ease in the first half of next year, whereas in the US, I think that will be a much later story. So going back to portfolio and how we see the market going forward, we think that next year is going to be a good year for bonds, thankfully, and we think that basically you need to have a more dynamic approach because things can change within half a year. We might have a higher rates for longer situation for the first half of next year, but then in the second half things might change, and therefore I think that as a multi-asset investor, you're probably sick of hearing this, but dynamic asset allocation is pretty important, I think.
Yeah, Alec, anything to add on the macro and maybe specific to China? or Asia, whatever you want to talk about.
Yeah, sure. I mean, maybe I'll before I talk to what we should pay attention to in 2024, spend some time to maybe recap on the past performance of China stock market, where China is, and going forward, what we should pay attention to. So I think you have the slide that
Oh, yeah.
we can put it on.
This one?
Yeah.
Yeah.
So the chart on the right that shows the divergence in terms of stock market performance between China and the U.S. It's quite big. If we actually expand the horizon all the way back to 2021, so the stat is since 2021, U.S. stock market went up by 20%. Chinese stock market went down by 40%. So that resulted in China's stock market valuation very, very cheap, which showed on the chart on the left. So China's stock market valuation currently is very cheap in terms of relative valuation relative to its historical valuation. In terms of absolute valuation, it's also very cheap. So that's currently it's about 9 to 10 times of the market earnings per share forecasted for 2024. If we pick the hottest stock market in the world today, India, the multiple is about 18 times or 20 times, give or take, but on the similar level of growth, right? So China, let's say 2024 is expected to grow 11%, 12%. Same level for India. US is even less. So what that means is you can get the same growth in China at half the price, if not lower. So Chinese stock market is currently on sale, right? So that's where stock market is today. Now, how do we bridge that gap between the fundamentals and valuation? I think there are two things that we need to pay attention to in 2024. Number one is the policy, and secondly is the consumer confidence. When it comes to policy, the government has been introducing supportive policies, but the market hasn't been satisfied because policy strength isn't enough. Efficacy is in question. Now, if we in 2024, if we see policies, especially the physical policies that amounts to government borrowing debt, central government borrowing debt, not the local government, the central government borrowing debt, to directly help the ailing part of the economy, for example, the properties or local governments with the high leverage. I think that is a very bullish signal. So that's one thing that we should pay attention to as an investor. Secondly, it's consumer confidence. It's very, very low right now. I mean, you can see that I think a lot of media talk about the savings rate in China is very high. People are not spending; they're just putting the money in the bank. They're earning less than 2% deposit savings rate, but they're still not spending. At the same time, they're lowering the leverage by prepaying the mortgage, right? So people are sitting on a large pile of capital, but they're not spending because of low confidence. But we think it's going to gradually improve. It may take time, but it's going to gradually improve. And then we are seeing some green shoots in China. So for example, retail sales on a month-to-month basis has been improving in China. And just by the nature of the economic cycle, in some sectors of the economy, we are already seeing the end of the destocking, and it's entering into the restocking, which means that businesses will restock, buy more inventories, which will drive demand, which will create more job opportunities. So as the economy, coming back out of that cycle, down cycle, we think the consumer confidence will come back. So good policy support plus consumer confidence reigniting will help the stock market, we think. So in short, I think in China, you got to remember right now it's very cheap. The fundamental is still very solid. It's still growing. And people, consumers especially, are sitting on a large pile of capital, all of which are very conducive to a stock market rally. So I think 2024 will be a very interesting year for China's stock market.
Thanks, Alec. And maybe we'll stay on China a little bit longer. Historically, as an investor, we say that valuation is never a catalyst in and of itself, right? Cheap can always get cheaper, expensive can always get more expensive, as we found out with US technology and on the other side, China. So, even this chart, if you go back to 2018, immediately your story breaks down, right? So, a valuation in and of itself is not, but what is the catalyst that's going to drive? Is it growth? Is it earnings? what is that's going to change? And not just Alec, I mean, either of you, if you want to chime in on China macro, growth outlook, please do so, yeah.
I mean, just to follow up on what I just said earlier, I think the economy, although it's growing slower than what people initially expected right after the COVID exit, it's still improving, right? I named in a couple examples retail sales, and in certain sectors of the economy that's entering restocking. For example, the smartphone value chain, we're already seeing some of the restocking happening. Right? So that is just part of the business cycle that's coming back up. That alone, we think, is not enough to sustain a long rally. The policy is also quite critical. The government introducing a very supportive policy that shows that they're quite determined to help out the economy, especially coming from the central government. I think that's really the key. And I mean, like our colleague said earlier, the U.S. Stopping or slowing down the rate hike is very hard. It's good for China actually. That gives the Chinese government some policy leeway to maintain the low interest rate and continue to borrow money, I mean printing money, if you want to call it that way, to help out the economy. So previously, there's that concern of the depreciation of currency, which sort of put a stop for the government to the extent which the government can help the economy. But with interest rate pressure easing off, I think it's also another sort of tailwind from policy perspective.
Okay.
Just coming back to your point about valuations, I always thought that valuation is like if you build a campfire, you put the wood, you lay the wood down, very nice, very big, but you need that spark to get that fire going. And the question I think you're asking is, what's that spark? Two things. One is, I think the property market is still the key to all of this, because if you think about consumption, I completely agree with you that savings rate is high, but when you've went through a sharp drop in equity market and a little bit of a correction in the property market, the wealth effect, it really hurts people. And obviously the job market is something else. So you need the property market to start moving up to create that positive wealth effect, which impacts on consumption, which impacts on investment, which impacts on local government spending and revenue. So to me, that's really the missing piece for the macroeconomy. The second thing is, when we speak with clients in the US and Europe, to be very honest, I think in the last 2 years, because of geopolitics, because of a number of reasons, they become quite cautious in investing in China. And therefore, their flow is important in driving the rally, and sustain the rally. So I think if you start to get, for example, we're starting to hear a number of Chinese companies looking to list back in New York. And if those listings well received, it means that US investors are overcoming their fear of investing in China. That, to me, that could be quite a constructive signal for more money coming back to Hong Kong and also to China. So, I'm absolutely looking at that spark. Macro is a big part, the property market, but also I think US and European investor appetite for Chinese and Hong Kong assets, that's really important.
I think over the past couple of days, we've heard very interesting news from Moody's that they have downgraded the outlook for China and for Hong Kong. I think it really boils down to sentiment. I kind of agree with what Tai said. If we actually talk to our colleagues in London or in New York, do they have a separate allocation to China? Probably not. It's only us in Asia where, as an Asian investor, we would actually invest in China, especially in Hong Kong. So I think without really big bang type stimulus program that Chinese government is rolling out, it's very hard for us to see, a very positive catalyst for the Chinese equities market to go up. But that doesn't mean that, for example, in our multi-asset portfolio, we're not substantially underweight China because, when policy comes out, the rally can be so quick and so significant. So we can't really afford to be underweight Chinese and Hong Kong. So we're more of, a neutral stance until we see further, concrete evidence that there are going to be a lot of stimulus coming out. We would prefer to have a wait-and-see approach.
Right. We'll come back to China a little bit later, but maybe we switch gears and focus on the US, we talked about the macro outlook, the Fed, interest rate outlook. I think there's some alignment among the group here about the outlook. I think the markets maybe it went ahead of itself when the rates were rising, and then became complacent. Now, and then they got too aggressive again, and now they're getting inflated. It's like normally how markets react, right? They go to extremes. But let's say a base case where interest rates have or are close to peak, and even if they raise another 1%, the delta actually, and the impact on fixed income through the duration impact is actually very minimal, it feels. We've seen the big move down and then the rebound. So, looking out to next year, and if interest rates are relatively stable and the consensus may be looking to see some rate cuts in the second half, the base case is actually growth is slowing, but that is the biggest risk still. What if growth does actually slow down more meaningfully, especially in the US, because things have been so good? We know that policy takes time, not just in China, but US. Especially interest rates are a very blunt tool. It takes many quarters for it to really have a meaningful impact, and it's compounded right now. So if growth slows down meaningfully, how does that look out for equities? And maybe I'll start with Chloe, because in that scenario, fixed income actually does okay, equities doesn't.
Yeah,
Would you agree?
Yeah, I definitely agree. I think that would more or less be like a hard landing scenario where growth, slows down quite a bit. If that's the case, as a multi-asset investor, we'll definitely turn to rates. From the equity side, it really depends on how resilient the earnings are. I think right now, we just concluded the S&P 500 earnings season, and actually it's not too bad, I would say, from our point of view. Over 80% of the companies have beat earnings expectation, and earnings revision are still kind of grinding higher a little bit. So if growth materially slows down, obviously it would have an impact more or less to a lot of companies, but that would be in the future. I think that we need to be a bit more sort of dynamic in that sense. If that really happens, then probably we will lower our equity allocation. But then it really depends on how earnings are doing at the same time.
And maybe, go ahead.
So when we look at our outlook for 2024, sort of a hard landing recession is very much on one of the core scenarios, or one of the risks that we're looking at. That is actually relatively easy to allocate for, because you just go straight to government bonds. You expect bonds to come a lot lower. But if you have to invest in equities, I would suggest two things. One is you typically will move into growth sectors, because lower rates, you get more valuation re-rating. The expensive stocks can afford to get a bit more expensive, and at the same time, you're looking for large cap quality names, because these companies, through the cycle, they have better cash position, they are more resilient in terms of their earnings, and there are some companies that overlap both growth and large cap. Actually, there's a lot of those who've done extremely well in 2023. I can't name names, but you know who they are. So from that perspective, there are still opportunities in equities, but you just have to find those that react well to a lower bond yield environment, and typically that's growth, that's tech, and also some of the large cap quality names that you see.
Yeah, thanks. And we'll stay with that. Maybe US and technology have massively outperformed again this year, and everybody wrote them off after a tough year last year, and it's come back strongly. Quality, strong balance sheets, no need for borrowing, right? And good earnings, surprisingly good earnings. A lot of things going for it, but obviously valuation going against it. And that's another reason why we say valuation in and of itself is not a catalyst, largely ever. So, in that scenario that Thai played out, that's US technology again? Is that the only play in the global equity markets?
Yes and no. I think a big part of what has happened this year is not just about yields and quality, but also the AI developments. So almost exactly a year ago, we all started playing around with ChatGPT. I was playing around with that all afternoon. But I think the development of this is no longer just going to benefit a small number of companies, the Magnificent Seven or Six or what you call them, but it's going to be companies who start adapting to this technology. So, for example, banks are looking to improve their efficiency and reduce costs. I've seen advertising companies looking to be much more targeted towards their customers. So I think over the next 12, maybe 24 months, possibly longer, the whole AI concept is going to go from hype to more embedded. I think that to me still allows for some good performance in technology, but it's no longer limited to those who develop the software or the large language model or produce the GPU that drives those AI calculations. So I do think that, yes, tech can still be leading the way, and in fact, if you look at long term, technology has always been outperforming in earnings per share over a 5-10 year period. But I do think there is a bit of some of the leftovers or forgotten names in the markets that could potentially perform well alongside with those who are directly involved in AI development.
Gen AI, I mean, it's a topic du jour as well, which I know, but in a very positive way. The drama at OpenAI, but I think from a wealth advisory perspective and as a technology company, the way we look at Gen AI is that it's not about some algorithm that's going to solve all your problems. It really is about the two E's. There's two things. One is efficiency, and the other one is enhancing the experience, right? So from an efficiency perspective, and the word co-pilot is probably the best explanation of what Gen AI really does. For our engineers, it could enhance their efficiency so they can code 30% faster. I just saw somebody send me a deck from Silicon Valley about some company that is their tagline was, "We are experts in AI and Excel." So they're gonna revolutionize the use of Excel for individuals and corporates through AI. And so, as Tai said, it's going to be pervasive. It's available to everybody and it's low cost. And it may have meaningful implications for businesses in terms of efficiency. And those that touch clients, end clients like Endowus, it's about the experience, the customer experience. And so we just launched actually the first wealth chatbot. We call it WealthWise AI, which is the data lake, and then we apply it to chatbot and client interactions. 30% of our interactions are now through the Gen AI chatbot within weeks, and a lot of success stories. We're going to implement it for the way you search and look for the suitable funds that you have. So we have over 300 funds. What is most suitable for me, for the goal that I have, how I implement it. So just a quick plug on Endowus' Gen AI tech development, but also I think that concept of focusing on what Gen AI is in terms of efficiency and the experience enhancement will give you a good idea of what's to come in all verticals, all industries, not just wealth. With that, any other thoughts on technology? Any subsectors that look exciting? Alec, I do want to ask you, how does China kind of respond to the development of AI? How does the China tech sector look like for you over the next 2024?
Well, actually, talking about AI, this theme, if you look at the performance of the stock, there are two areas that really outperformed this year. One is AI, the other one is SOEs.
Two extremes.
Before, exactly, yeah. So in summary, the market return is quite narrowly focused, very concentrated, and the rest of the sectors are all underperforming. But as far as the AI in China is concerned, I'm not going to spend too much time on that, but I think the market reaction is way ahead of the fundamental improvement, which drove the sort of rally in those sectors, but mainly sentiment driven, not fundamental driven just yet. And then we're still kind of staying on the sideline to see whether they can actually convert that into real numbers, into dollar amount. But some of the companies that we invested in, they are already investing in AIs. So I think we'll see. I think it takes time in China.
I think just to supplement a little bit, investors do want to play the theme of AI, but then at the same time, a lot of us, including us, are actually scared of the valuation in the US. So actually, I guess one of the ways that we can sort of harness the potential of AI is actually looking at Taiwan and Korea. The manufacturing cycle is actually picking up, and a lot of the companies in Korea, especially in Taiwan, are actually sort of normalizing their export cycle, and the semiconductor cycle is actually back to normal now. So we do see potential for talking about this AI theme. It's not only about the U.S. There are also other ways that we can play this AI theme through other countries as well.
And let's delve into that because everybody loves to talk about the US and China, but there's so many other countries in the world. And Europe has surprisingly done well for a while, and then recently there are concerns. Japan, India, is everybody's favorite market. Korea, Taiwan, sneakily outperforming. So let's talk about some other markets. What are some of your other favorite markets that we should keep an eye on as we go into 2024?
Yeah, I would agree it's Japan for now. I think that, Japan's economy is in a really good state. We are based in Hong Kong. Hong Kong people love to go to Japan. And
not just Hong Kong.
Yeah, not just Hong Kong. Not just
half of Singapore's in Japan right now.
Yeah. And so with the yen being so cheap, even though it rebounded a bit recently, we still think that it's pretty cheap in a historical standard. And the reason why we like Japan is not only because of the yen, because a lot of the companies in Japan are export-oriented countries. The yen is doing them a favor, but also because the economy in Japan is doing good, and also there are a lot of shareholder-friendly actions that took place a few years ago, which is actually paying off quite well. So a lot of the companies in Japan are actually really, really good quality companies, and when the time is volatile, we want quality companies like Tai suggested. And so these shareholder-friendly actions prevent the companies to have hostile M&A actions, focus on organic growth is actually paying off quite well. And I think Japan this year, in yen terms, it actually grew by 30%. The Japanese equity market returned by 30%. Obviously, one caveat is that you need to hedge the currency because if not, then your US dollar return would only be about half of that, I would say. And so in a lot of our portfolios, we are actually long Japan, and then we hedge it back to the US dollar.
But that worked, but what if US dollar starts weakening because the interest rates start coming down in the US? Do you think that will adjust back and you should be exposed to Japanese yen?
I think that if that is, well, first of all, we don't think that is...
That's not the base case.
That's not the base case, at least for the next, let's say, three months. We still think that the yen is going to, I wouldn't say not appreciate, but it will stay in a range-bound sort of area. So for now, I think that we still need to hedge it. But you're right. When the U.S. starts to ease, yen is going to go up, and that's another story.
Yeah, I think Ty's been waiting to speak.
I think Japan's a great idea. I do think the Bank of Japan is operating in a very cautious way. It's old school. It tends to wait until things are 110% confirmed, then they move. So I agree with Chloe that at least for the near term, the yen is going to stay weak. So great news for those going skiing on Christmas and Chinese New Year. But I think another interesting nuance with Japan is the corporate governance story is really important. It's been happening since 2012 when Abrdn started to roll out. And at the start, no one believed it, but after almost 10 years, over 10 years, it is working. So what you see this year in Japan is a value rotation or value-driven rally where a lot of cheap companies, because they're buying back their stocks, that drove their performance. But I think on top of the value investing methodology, you can also look at the growth sectors, which are a bit more expensive, but many of these companies which are not household names, they are well leading. Some of them are. My kids, when they play the handheld, again, no name mentioned, but you know which one. Those guys, they actually do really well. So I think, a really important point is, since I've been with JP Morgan for 10, 11 years now, this is the third time that Japan has attracted attention. This is the one time that I felt that this is going to be sustained. Other markets that I think is interesting, back to the export cycle, again, I agree with you completely. Taiwan, South Korea, maybe Singapore. It's been a very tough year for exports in Asia this year. We're starting to see some green shoots, and I think next year should be a year of exporters after the last 2 years where we've been advocating more domestic demand because we're getting out of COVID. So again, the rotation could well benefit some of the more export-oriented markets like Taiwan, like South Korea, Singapore, bits of Hong Kong, but at the same time, I would be a little bit more cautious towards, for example, India, where it's more domestic, but also the valuation is pricing in good growth for the next year or two. Long term, fantastic story, but in the near term, it might need a bit of consolidation.
Okay. So far, Ty and Chloe agree on pretty much everything. Do you agree with India, Chloe?
Exactly to the point.
Really?
Nothing to say.
So that's the contrarian bet, India. It really is a favorite market for a lot of investors, especially overseas, global investors, because of its long-term track record of delivering. But it has underperformed when the rest of Asia and emerging markets actually comes back. So that's an interesting factor that I think we need to consider. Alec, can you comment on Hong Kong, like China A versus H, and what's your contrarian kind of bet this coming year?
Well, maybe
you're not bullish India, are you?
Well, I'm bullish India. I can be bullish India on the side, but my day job is in China, so I have to say I'm long China. But I have pretty good reasons. China is really exciting. If I think myself as a retail investor, and I just tell you the valuation is really cheap, right? China is not going to go away. 30% of the manufacturing capacity is in China. World's manufacturing capacity, 15-20% of the export is from China, right? China's GDP per capita is only 20% of the U.S. Japan achieved that back in 1980s. After that, Japan went through this three lost decades. They were still growing at 4 to 5%, right, per annum. China hasn't stopped growing. In fact, I think the recent study shows that currently China has 200 million middle-income households, defined as annual income of over $20,000 US dollar. By 2030, the number will reach about 400 million. 400 million, that's double the size. 400 million is equivalent to US and Europe combined, right? So, we are long-term positive on China because we are positive on the increase in consumption power, increase in the wealth of the people of China. So as people get rich, they'll ask for better things, right, in lifestyle. So they'll ask for better food, better quality clothing, better travel experiences. They'll ask for better technologies, better ways to do things, more efficient way to do things. They'll ask for better health care, a better way to invest or preserve their capital, other than investing only in property. Currently, 60%, 70% of their wealth is tied to property assets, right? And they'll also ask for better environment. So the green energy area has been growing super strong, right? So these 5 areas. So do you have a slide on? Yeah. So based on this long-term belief, we came up with this 5 things. We think we can find the best opportunities in China in those areas. So we call it aspiration, digital, green, health, and wealth. We think those 5 areas will face structural growth. They'll continue to grow, faster than the economy. I think China is currently cheap. There are still some areas with the structural growth stories. So we stay long-term bullish.
Sounds good. We're gonna shift gears again and talk about this perennial debate between active and passive investing. Obviously, I think the jury's already out on the benefits of passive investing, and in Endowus we espouse a strategic and passive asset allocation, and we think that you should always have a core allocation to passive, globally diversified indexes. But when is the right time to play active? Is it at certain points in the cycle? Is it, we only allocate to strong managers who generate alpha consistently over cycles? Do we play alpha through, private markets? What is, where is the role of active management and investing? Especially where we stand with high interest rates and growth potentially slowing down. Anybody want to take it first, or Alec, you want to take it first within a China context first, and then we'll broaden it out to the other markets and other asset classes.
All right. I'm biased because I'm an active manager, so I have to say yes. But I'll give you 3 reasons. I think, again, there's a chart I brought. there's three reasons, right? Based on our
Actually,
historical.
I'm just going to tell everybody, Alec sent us a deck with 36 slides. I managed to cut it down to 3, okay? So I saved you guys the other 33. But really good slides, Alex, so yeah, let's go into it. Yeah.
All right, why active investors over passive? I think really three reasons. Number one, the historical track record. This is our performance since inception in China, 2015, outperforming the benchmark. And we are the bottom-up research house, and we invest in quality stocks and holding the long term. So I think the track record speaks for itself. Secondly, now is really the good time to take the active investment approach in China. China's economy is going through the structural change. That means the economy overall, some areas of the economy is slowing down, real estate obviously, but some areas are still growing. So taking an active approach, active investment approach, can be a good filter to screen out those lower quality companies and to have a direct exposure to the high growth areas. And finally, one of our strategy to generate alpha is to engage with the companies that we invest in. We don't just buy and hold. We engage with the company to help them improve the ESG. As a lot of you may know, the fund management industry has been increasingly focused on ESG, which means that companies that have high carbon footprint, they may not be able to attract capital anymore. But on the other hand, company that has improving ESG ratings, they can attract capital. So, which means a lot more capital will chase after those quality companies, right? So, one of the examples that for us is a couple years back we invested in a cosmetic company, a Chinese cosmetic companies. At the time we invested in them, their ESG rating is very low. It's about CCC. So what we've done is we've engaged with the company, we talked to them, and try to improve their disclosures on their ESG practices and advise them on the best practices in the industry so that they can set up the right framework and have key stakeholders really focus on improving the ESG with the proper KPIs. So after that, subsequently the company got the ESG rating was improved to BBB, from CCC to BBB, and correspondingly there's their share price increased and there's multiple re-rating. So that's one of the examples how we sort of through active investment generate alpha.
Thanks, Alec. Anybody else want to add?
Yeah, I think active versus passive, as a multi-asset investor, our general view is that alpha is more available in Asia, where the market is not as efficient. So if you look into the US, it's dominated by ETFs, and it's very, very hard, even though we are an active manager, but it's generally very hard to harness alpha in the US. So when we allocate our portfolios, we do want to sort of preserve that risk budget to funds that are able to generate alpha in Asia. So we allocate a little bit more towards active fund in Asia. And I think...
Can you explain for those that are less familiar with the concept of risk buckets, can you just elaborate a little bit there how you do that?
So for example, let's say we are managing a fund against a benchmark, right? If you invest in ETF, it's just basically investing in the benchmark. But if you're investing in the in active strategy, there is a potential for that active strategy to generate alpha, but it also brings you risk. So where do we want to allocate risk, right? So for us, our experience is that alpha is more abundant in Asia. You really need to talk to the management, like what Alex suggested, in order to find these opportunities. But we also want to sort of avoid the risk, because if you don't talk to the management, you don't know whether or not the company is sort of legit, I would say, and you can't really tell from balance sheet. And therefore, what we mean by risk budget is that we would rather use that sort of tracking error to allocate to funds that are in Asia, where there are more alpha opportunities than in the US, where it's predominantly generated, predominantly dominated by ETFs.
Great explanation, but that's one of the concepts that I think that most people should take away. What Alex and Chloe said is that inefficient markets actually provide opportunities for alpha, And so China is an example, Asia, and emerging markets as well. Tai, you want to?
Yeah, I think two things just to add. I think echoing what Chloe mentioned about ETFs. ETF is known for being cheap to run, passive, but you will start to see more, something known as active ETFs coming into the market, where it is still actively managed. So the research, the communication with the management, they will be embedded, but at the same time, you do get daily liquidity, you do get the transparency. So it is something that we've started to see taking off in the US. We're starting to see a bit of that happening in Asia. I'm sure over the next few years, that will also be more familiar to all of us. The second point, we didn't really touch on private markets. And that's where I think active management is absolutely essential. I wish I had a slide, but if you look at the differences between the best manager and the worst manager in an equity fund or a fixed income fund, you're looking at 7 percentage points. But if you're looking at a private equity fund or private credit fund or real estate fund, the best and the worst could be 10, 20 percentage points. So overall, if you're looking into investing in a private market investment opportunity, picking the right manager is absolutely crucial. Very simply put, if you look at real estate, if you're investing in San Francisco today or Seattle versus someone investing in Miami or Texas, the difference is huge because of the people moving from San Francisco and Seattle to Miami and Texas. So that very simple example will already tell you if someone is an expert in the South, they're more likely to outperform someone who's going to be an expert in the West. So when we talk about active management, I know it's often associated with being a bit more expensive to run, you have to pay for access, but the reality is, especially in the private market, it is something that is absolutely crucial to find the right manager to get the best results you can get in the private markets.
Since the topic of private markets has come up, maybe can we comment on the prevalence of private equity? Maybe less familiar in Asia, but I think globally private equity has been such an over-allocated piece, and so the global GPs are actually trying to diversify their funding source away from institutions who are kind of over-allocated and looking at the wealth space. So that's one of the reasons why we're partnering with many GPs to provide best-in-class private equity solutions. What are your thoughts on private equity versus public equity at this point in the cycle?
I think at this very point, I'd just be mindful of the impact of higher rates. I mean, ultimately, since 2008, we've lived with almost a zero rate environment for a very long time, and therefore a lot of private equities and private credits essentially have been feeding off that low rate environment. Now, that's not to say there are not good opportunities in private equities, but at the same time, you just have to be very mindful of what sector they're looking into. And the reality is, with risk-free rates at 3, 4, 5%, investors are going to be more brutal in picking companies that are making profits or companies that are not making profits. So I think the profit viability is no longer someone in a t-shirt telling you some fancy graphics, we're going to make X billions of dollars in 10 years' time. I think the business case needs to be a lot more solid, and it comes back to my earlier point. If a portfolio manager is familiar with the experience of technology or in healthcare or in other parts of the industry, if they understand how things work, they're more likely to pick the right startups or right companies that will evolve into profitable companies that can deliver return to investors. So a bit more picky. I think investors will be more scrutinizing those who can ultimately generate profit. So I think that's the word of caution here.
Yeah. Anything to add, Chloe, or private markets? No? Okay. Why don't we open up to the audience? I think you guys have waited patiently. I've asked all the questions. Yes, please. Just shout, I'll repeat.
I have a question. In case I noticed that you are very interested in Japan market, you mentioned the key points for the momentum in Japan market next year. So do you have any allocation in Japan?
Do our portfolios have any
Allocation to
Yes,
Japan?
we are actually long Japan right now. So in some of our portfolios, let's say compared to the benchmark or just in absolute terms, I think we've added about 5% to Japan over the past, started about 3-4 months ago. Yeah, so we've added towards Japan compared to the benchmark. We're about 5% overweight.
You focus on the large cap or
Yeah, the large cap names. So if you actually look into the large cap versus small cap names this year, I think it's because of the investor sentiment. Large cap names have done phenomenally well. Is there a chance for the small cap to broaden out? Possibly. We think that will probably be the case, and we're hopeful that even the small cap companies, as the Japanese economy focus more on domestic when wage is actually starting to grow a bit, potentially some of the domestic companies will benefit as well. So benefiting some of the small to mid cap names.
Thank you for sharing.
Any other questions? Yep.
I think the Hong Kong market outlook has been shared a bit limited.
Okay, sure.
So can you share a bit of an outlook on the Hong Kong equities market?
Hong Kong market. Alec, closest to it? Or?
Yeah. I don't know, maybe Ty can add. I'll just say briefly, I think we still prefer China A share to Hong Kong. Just because the China A share is more diversified and there's more industries where you can invest it into, whereas Hong Kong is quite limited as compared to China. That's one. And secondly, Hong Kong market, based on the this year's experience, actually is more subject to or more vulnerable to the fund flows. So the volatility has been quite high. Yeah.
Yeah, I'll take a slightly different view. If I ALH, I personally will lean a little bit more towards H for the time being. And that's because if you think about US and European investors, I Chloe touched on this earlier, when they invest, they don't think China, Hong Kong, India, Japan, South Korea, they think Asia or EM. So when the dollar is getting weaker, investors allocating more to emerging markets in Asia, yes, they may underweight Hong Kong, but it doesn't mean there's $0 coming to Hong Kong. However, because of the capital control, various limited restrictions, international capital that will go into China is likely to be a little slower, a little bit smaller. So I completely agree with Alec that if I look at companies and opportunities and I'm betting on consumers to recover, there are tons of opportunities in the Asia market. You can go into a lot of details, alcohol, different types, the consumer goods, different sports or other things. But in Hong Kong, simply from a capital flow perspective, I think you will get a little bit more of an early flow into Hong Kong. And once that momentum starts to build, I suspect you start to see A perform well as well. So I will start with H, and then once that confidence starts to build, I think A will also benefit.
Great. Any other questions? Yeah. Daniel.
So what I hear from the China market is that one of the primary factors is how much government support policy there is for real estate. What are some just examples of policies that could come out just so we can see or we can be on the lookout for those types of things?
I think a couple of things, right? One is the government has already announced the plan to, I think, issue $1 trillion to fund the urban renovation projects. I think that is sort of indirectly investing in the economy and building the projects. It's not a lot actually in terms of the units, housing units that they can generate. I think it's still single digit, but I think that is going to be a good signal to the economy, to the people in China, that the government, central government, right, is really helping the economy. And one thing to look out for is really the funding source. Where is the funding coming from? I think that's currently pending still. And very likely the government, the central government will take on the leverage. I think to me that's one of the bullish signal. On the fringe, I think there's also is reported but not officially confirmed that the government is drafting a list of 50 developers, a wide list of 50 developers who can get access to unsecured funding, right? So that in a way is an effort to stabilize the real estate market. So that helps, but what we need is really demand stimulation. And when it comes to demand stimulation, it's really that kind of putting money directly into the economy, that would have it would be more efficacious.
So you just want to add anything?
Very briefly. I think what needs to happen is you need a little bit of an upside in property prices. Because anyone in this room, if we tell you that a stock's going down 10%, you're going to wait. If I tell you that stock's going up 10%, you'll be skeptical. You might wait a bit, but you might still act. So from that perspective, if you think about, again, where we come back from, the property market, consumption, investment, local government spending, if the public start to think, oh, property prices will go up by 10% or 5% in the next 1 year or two, they start moving in, that virtuous cycle of markets start to take place. Now, all of that's been sort of taken away because the government's been insisting that we want to improve housing affordability, which absolutely is the right thing to do. However, the impact on the housing market and the economy, I think the government may have somewhat underestimated. So, to me, an important trigger, policy is going to be key. But at the same time, if you start to see property prices start to drift up a little bit, and investors' appetite start to return, I think that's going to be really interesting.
Great. Any other questions? Maybe one or two more questions at the back? Yeah.
Yeah, got a question around longevity risk. So, the question is, do you see aging population having a long-term impact on economies such as Japan or China versus, say, India or Vietnam, who have a very young population and therefore have a motive to grow? That's my question.
Yeah, great question. Chloe, I can take this.
Sure. Actually, this is a very interesting topic because one of our themes this year from Schroders is that demographics is actually one of the 3Ds. China and Japan obviously is in a little bit more difficult situation where you don't have enough young population. But like you said, in India, we think that like Tai suggested, structurally there's so much to love about India because of the population and because of the demographics. They are just starting to get more digitalized. They're only starting to get more, the bank accounts set up and all that. And there's so many young populations in India where, the digitalization in India is just starting to take off. And there's immense opportunity there. And therefore, from that perspective, I think this is a very long-term trend that isn't going to be realized until, let's say, 5 to 10 years later. But certainly, if as a stock picker, if we are in the right sector, we definitely see a lot of opportunities there.
Just on that, I think maybe if I can add, growth. What is growth? I think that people forget that demographics is actually one of the most important drivers of growth in an economy, right? The other one is productivity. So you talk about the factors of production, and then you add productivity, and actually the biggest tailwind to any growth is actually demographics. If you look at the US economy and why it did so well for so long, is because of its open immigration policy. US actually has historically had a 3% population growth. For a mature, rich, economy, that is phenomenal. No other economy in the world, Japan, Europe, mature economies and rich economies, they become stale because the demographic becomes a headwind as opposed to a tailwind. And so, if you look at it from that perspective, India and parts of Southeast Asia, the Middle East, Africa, Latin America, that's why people are sometimes bullish from a structural perspective on demographics. But the other one is productivity. So we have to understand that. Yeah.
I think this comes back to the earlier question about active management.
Yeah.
Because if you think about aging population, yeah, it may not be great for that country's or that economy's GDP growth in the long term, but as investors, there are things we can pick on. I don't buy baby diapers, I buy adult diapers. I buy healthcare. We talk about starvation in parts of the world, we talk about obesity drugs in other parts of the world. So I think the demographics and how things work is absolute. So when we build our long-term capital market assumption, our 10, 15-year growth projection, labor market growth, productivity is the absolute key ingredients. But when we think about investment opportunities, old people buy stuff too. So how do we tilt our asset allocation or our stock picking towards an older population? I think that creates an opportunity, and that's where active management comes in.
I think that also relates to the concept of, you know, the macro economy as a whole versus what the financial market or capital markets represent within that economy. So sometimes there's a big divergence because, you know, the stock market doesn't represent everything. It actually is geared towards the most biggest profitable companies. But look at China, a lot of them are not listed, you know. So India is another case. So private markets, you know, a lot of great startups and venture companies actually don't, you know, go on to list in public markets anymore. They stay private for longer. So I think we have to consider all those like intricacies and extrapolating your macroeconomic view or macroeconomic trends into actual stock market investments is another different thing.
So I just have one question. We touched upon macroeconomic factors and also demographic factors and other stuff. But how do you see geopolitical risk impacting the markets?
Yeah, this must be the only equities session where we didn't talk about geopolitics.
I mean, 2024 is the year in which 40 countries are going through elections.
Yeah.
So, and in fact, we have already started
Massive.
seeing that. So, how do you foresee and how do you factor in while projecting for 2024?
Kind of know what everyone's going to answer, but yeah, I mean, we're going to give it a shot. The standard answer for all equities kind of investors is that geopolitics doesn't matter over the long run. So because we look at all the studies of the impact of geopolitics, of war and other things, and yeah, short-term impact over the long term, it goes back to the fundamentals of growth and earnings and valuations and everything else. But is there a contrarian view here or anybody really worried? Because next year is a special year, like, you know, even within the context of normal cycles.
I think, first of all, in terms of geopolitical risk and domestic election risks, the simple way to manage that risk is diversification. Right? Yes, there are 40 countries. I think most of the largest democracies, India, Indonesia, US, maybe the UK, they have elections. And some of them will matter. I think, you know, for example, India, it looks like that Prime Minister Modi is going to be re-elected, so, you know, markets could be relatively calm. But with Indonesia, you're definitely going to get a new president, and where is that going to go? Obviously, the US is a big question mark. So the first thing is we still think that diversification is the easiest thing you can do to manage that risk. Then you can look at individual economies and election results. And that's where I think, looking back to history, it provides a bit of a precedence, but the truth is, it does depend on the candidates and the platform. And if you look back to the trends of how politicians have campaigned 10 years ago, 20 years ago, right now, is incredibly different. And also, one thing I think everyone needs to remember is campaigning is not running the country. What they say on the campaign trail is not going to be what happens in the actual management, because either they will mellow down or because the composition of the parliament or the Congress does not allow them to execute the extreme policies they've advocated for. So this requires a lot, again, active management. We need a lot of research and understanding of how each individual election is going to play out, what are the scenarios that could turn out. So I think it's difficult to have a blanket statement of is good or bad or no effect. It does depend case to case.
I think I'll just divert the attention a little bit. I know we're in an equity session, but given my multi-asset background, I think generally speaking, diversification is a key. And what we tend to notice is that, you know, when there are a lot of geopolitical tensions, some of the asset classes tend to do well, like commodities, especially, you know, when you have Middle East tension and all that. So when there are a lot of volatilities and unknown situations in the market, you know, for example, precious metals would do well as well. So just echoing back to Ty's point, you know, diversification, not only in terms of equities, but also in terms of different asset classes can help with your portfolio as well.
Just a couple of things. I think when it comes to China, the most important relationship is really China-US relationship. I think, I dare to say that it's already bottomed out. I mean, you know, it culminated with, you know, Xi and Biden's meeting before they haven't even, you know, met each other, right? So I think that signals that at least we can expect some kind of stability in the relationship. Of course, that election in Taiwan and election in the US will introduce some volatility. But I think worse is behind in terms of the relationship between the two countries. So that's one thing. Secondly, this may be a long-term trend, the geopolitics, right? So based on that, we see a lot of interesting opportunities popping up in China. So China trying to be more independent of energy, of the technology, the key semiconductor value chain. So, and then they in the critical segments, they try to sort of replace the foreign companies, and then try to develop the domestic companies. And that itself is an opportunity to invest in China. I think we are seeing the trend of import substitution in China. So
yeah, just to wrap up the geopolitics debate, I think that first of all, if you think about the global geopolitical events like the Middle East, Palestine, Israel, Ukraine, those are things that don't really have a meaningful impact to the global markets in particular, especially equities, because I think people overestimate the impact, let's say. For each individual countries, especially since you brought up the issue of elections, it is a very diverse range. So again, just like we talked about how there's inefficient markets and more efficient markets, does it matter whether it's Biden or Trump? Not really. I don't think that's really going to make a big difference to US growth or US Fed policy. That's just a cycle, right? But in Indonesia, where Jokowi's made meaningful progress, or Modi in India, those markets are going to matter more. Japan has a change in leadership every 6 months. And Abe was literally a little blip because it was a trade, and then it went back to its fundamentals. And as the 51st state of the United States, Japan's policy is driven more by the United States. That was a joke, sorry. There's no Japanese people in this room. Sorry, I apologize. But yeah, I mean, it's affected by global macro and US policy and other things much more than domestic politics. So I think we need to weigh that and also differentiate between the different markets. Any last questions? I do want to give time for you guys to mingle, meet the guys, ask further questions to individuals. But we have one last question from you, yeah.
Yes, going back to Japan, which sectors are more promising? Is it like the big traditional trading houses? And what was the best way to get in, if you have a long-term view on the growth story, right?
Yeah, let's go with sectors. We can't talk about companies, so sectors, but also how about factors like growth versus value, dividend versus growth.
You can take dividend well. Well, to be fair, they pay a bit more. But I would still stick with growth. I mean, regardless of markets, US, Japan, China, Asia, over the long term, growth tends to outperform. And you mentioned about some of the traditional names of trading houses. I think, if you think about the banks, if you think about the heavy industries that we all grew up with, to be honest, I think they are struggling to reinvent themselves. Maybe they can do that with the car industry, with electric vehicles, maybe. But we do note that there are a lot of new companies that have been growing for the last 10, 15 years that are leading the way in the global technology sector, robotics, pharmaceuticals, I mentioned earlier, entertainment. I think these are the areas that I would focus more on. But of course, as Chloe mentioned earlier on, those companies can genuinely make corporate governance improvements. That's the other theme I would really love, because it's easy to buy back your stocks for a year or two, but can you do that consistently over the long term or improve your dividend payments? That to me would be another key areas to focus on for long-term investment opportunities.
I think for the short period of time, next 3 to 6 months, we are more positive on the manufacturing industries. So the industrial manufacturers, car manufacturers, as well as robotic companies, that they are able to export a lot of their technology to the world. These are the companies that, in the short run, we still think that, given the yen is still stabilized, in the historical sense, quite low, we think that these are the ones that we like for now.
So I think that when we look at investors, we talk about consistency, right? I just recently met an Indian portfolio manager. The fund manager will remain nameless, but he was pushing India very aggressively, and his reasons for India were obvious. It's growth, demographics, it's all those things, and they said valuations don't matter because we're going to grow into it and blah blah, we're in growth. And remember, equities is a growth asset class, right? So if you're not in it for growth, then what are you in it for? And so he explained all those reasons, and then somebody asked about small caps and said, well, I don't like small caps, it's overvalued, you know, it's growing faster, but it's not really, you know, where we want to be, so I'm going to go with the cheaper, bigger, you know, and I'm like, wait a minute, you're not being consistent with your investment philosophy and application, because you talk about India as a growth market, then maybe small cap is the best consistent opportunity. And valuations don't matter, you said, for India, but why does it matter for small caps only? Small cap Indian stocks. So, you know, the reason I bring this up as I wrap up tonight is we have multiple fund managers here, and it's always important for you to ask the right questions when you select the fund manager, select the funds. And that's where Endowus comes in, because we do the hard work of due diligence with the fund managers, calling them out on their inconsistencies. So the professional expertise of Endowus to guide you in that process is important. But I'm really glad tonight that we actually are perfectly aligned and consistent, especially Ty and Chloe, but Alec and myself as well. I'm really glad that we've been consistent, and I hope that you took something away from tonight, you enjoyed the session. But they are going to be around for a little while longer, so please bombard them with questions, grab some more wine and food. Please mingle and get to know each other as well. Thank you so much for joining us today.